Welcome back to Talk Tickers. Today we're doing a deep dive into Darden Restaurants, DRI. They just had their Q1 earnings call for fiscal 26.
Yeah, September 18th, pre-market, and boy, did it cause some waves.
Big time. Huge volatility right out of the gate. The stock took a tumble.
Right, and that's really our mission today, isn't it? To unpack why. You had this really strong execution, great sales momentum, but then this near-term margin fear it spooked the market. The stock dropped, 8 to 10% almost immediately?
Yeah, classic disconnect. Management sounding confident long-term, the street focused entirely on the next quarter's costs.
Exactly. So let's try and square that circle.
Okay, let's start with the snapshot then, the actual results. Because like you said, it was mixed.
It really was. Revenue came in at $3.045 billion.
Which is up over 10% year over year. A nice beat, actually. Slight beat, but still a beat.
Yeah, top line looked great. No arguments there. The momentum's definitely present.
The profitability side.
Yeah, that's where the snag was. Adjusted diluted EPS was $1.97.
And consensus was looking for about $2, right?
Pretty much bang on $2.
Yeah.
So a narrow miss, just a few cents.
Doesn't sound like much on its own.
No, but you combine that small miss with the, let's say, gloomy cost outlook they provided.
And suddenly that's all anyone wants to talk about.
Precisely. Market latched right onto it.
Still, you can't ignore the operational strength. I mean, blended same restaurant sales up 4.7%. That's really solid.
Very solid. And look at the big brands. Olive Garden up 5.9% SRS.
Wow.
And LongHorn Steakhouse, another strong one, 5.5% SRS.
Those aren't just good numbers. Those are like top tier numbers for casual dining right now.
Absolutely. Top decile. Easily.
Yep.
That puts immense pressure on competitors.
Yeah, if you're running a rival chain, you're looking at those numbers and probably sweating a bit.
You definitely are. And management, they framed it as a strong start. They kept talking about executing their brilliant with the basics playbook.
Which, based on the sales, seems fair. But the market just shrugged.
Pretty much ignored it. They saw the margin headwinds coming and hit the sell button.
Yeah.
Even though Darden's actually driving traffic growth when others are flat or down.
So let's dig into how they're driving that traffic. Olive Garden, for instance. What's working there?
Well, it's a mix. There's menu innovation, for one.
Like the create your own pasta thing?
Yeah. They featured a new spicy 3-meat sauce there. And they had this limited time Calabrian steak and shrimp bucatini.
Okay.
Which apparently shot right into their top 10 entrees for guest preference, like almost instantly.
So people are still interested in new dishes, maybe willing to spend a bit if it's appealing?
Seems like it. But it's not just the food, it's also the reach. Logistics matter.
You mean delivery?
Uh-huh. That first-party partnership with Uber Direct. Management made a point of saying it attracts a younger, more affluent guest.
Higher average checks, too, they said.
Yep. And importantly, they think these are mostly new customers, not just shifting from dine-in. Incremental traffic.
Okay, that's key. And they pushed it hard, right? With that 1 million free deliveries promotion.
They did. Apparently, it doubled their average weekly deliveries during the campaign.
Wow. But did it stick? Promotions are easy, sustained volume is hard?
Well, according to them, yes. Post-campaign delivery volume settled about 40% higher than it was before the promotion started.
Okay, 40% lift sustained. That's actually pretty impressive. That investment seems to have paid off.
It looks that way. But maybe the bigger strategic play at Olive Garden, long-term, is this affordability test.
Ah, the lighter portion thing. Tell us about that.
So they took 7 existing popular entrees, reduced the portion size a bit, and reduced the price accordingly.
Okay. And they're testing this where?
In about 40% of their restaurants right now.
40% is a pretty big test. What's the goal?
It seems to be about driving traffic by hitting a lower price point, boosting that value perception. They said it lifted their affordability scores by like 15 percentage points in the test markets.
15 points is huge, but doesn't that risk lowering the average check size? Diluting the sales mix?
Potentially, yeah, a little bit.
Yeah.
But management seems willing to make that trade-off. They see it as a long-run traffic driver, widening the net for who considers Olive Garden affordable.
Interesting. So sacrificing a tiny bit of check today for more guests tomorrow, a strategic bet on value.
Exactly. Meanwhile, LongHorn just keeps chugging along.
Right.
At 5.5% SRS.
Driven by traffic, right? Not just price.
Yeah, traffic was up 3.2%, which, again, puts them way ahead of the industry average. Just a machine.
And the other brands, Yard House, Cheddar's.
That whole other business segment saw SRS up 3.3%. And Cheddar's, in particular, is playing the value card really well, leveraging Darden's scale.
How so?
They highlighted things like a Hawaiian sirloin starting at $16.49. Apparently, it held Cheddar's ranked #1 for price and affordability in recent casual dining surveys.
So they're executing that value playbook across different brands, tailored to each concept.
It seems that way.
Yeah.
The only real soft spot was fine dining. That segment was slightly negative, minus 0.2% SRS.
Including Ruth's Chris.
Yeah. Though they did mention a tactic there, a 3-course $55 limited time offer at Ruth's Chris specifically.
Trying to create some certainty, some value, even at the high end.
Exactly. And they said that specific offer actually did drive positive comps for the Ruth's Chris brand during the quarter. So some smart maneuvering even in the weaker segment.
Okay. So summing up the top line, really strong momentum, smart strategic initiatives rolling out, Olive Garden innovating, LongHorn executing, Cheddar's nailing value.
Right. Just undeniable strength on the sales side.
Which makes the stock reaction even more jarring. It got absolutely crushed.
Yeah.
So let's dive into the margins. Why the panic? Was the outlook that bad?
Well, let's be clear. The Q1 margin performance itself wasn't the trigger. It wasn't great, but it wasn't a disaster.
What were the numbers again? Commodity inflation was?
Pretty tame in Q1, actually, about 1.5%. Labor was hotter, though. 3.1%. The key decision, strategically, was that Darden priced below that total inflation by about 30 basis points in Q1.
So consciously choosing not to pass on all the costs. Protecting traffic, like we said.
Exactly, protecting the guest value proposition. But that comes at a cost, obviously.
And we saw that impact where LongHorn.
Yep. LongHorn segment profit margin dropped 60 basis points compared to last year. Management pointed directly at two things: higher beef costs than they expected, and their own decision to price LongHorn way below its specific inflation, like 100 basis points below.
Okay, so they took the hit there to keep the value message strong, especially with beef costs rising.
Right, and that leads us to the real bombshell, the updated cost outlook for the rest of the year. That's what cratered the stock.
What did they say?
They raised the full-year total inflation forecast for FY26 up to 3.0% to 3.5%.
Okay, up from what?
They didn't explicitly state the prior number in this section, but the key change was in commodities. They now expect commodity inflation for the year to be 3% to 4%. That's a big jump from the 1.5% they saw in Q1.
3 to 4% on commodities overall? Ouch. Is it broad-based or specific items?
Oh, it's specific.
Yeah.
And it's bad. They flagged high single-digit inflation coming for beef and seafood.
High single digits. Wow.
Yeah. Specifically hitting hard in Q2 and Q3. So the next 6 months, basically.
Okay, that is a major headwind, aimed right at LongHorn and the fine dining brands.
Exactly. And here's the kicker, the part that probably amplified the market's fear.
What's that?
Their hedging strategy, or lack thereof. They admitted they only have about 25% of their beef needs covered for the next 6 months.
Wait, only 25% coverage on beef heading into a period where they expect high single-digit inflation for it?
Yep.
That sounds incredibly risky. Why would they do that?
It's a conviction bet. Management basically said they do not believe these current high prices for beef, especially tenders and ribeyes, are sustainable.
So they think prices are going to crash.
They expect significant demand destruction at the retail level to eventually force prices down.
Right.
They explicitly said they don't want to price their menus based on what they see as temporary costs.
That's a massive gamble on the P&L, though, if they're wrong about that price collapse.
If they're wrong, the second half earnings guidance could be in serious jeopardy. It's a huge point of contention for investors. Why trust their forecast now when they were under-hedged coming into this spike?
That's the billion-dollar question, isn't it? But they are sticking to the full-year guidance for now.
They reiterated the full-year adjusted EPS range, $10.50 to $10.07. But, and this is crucial, they gave a very specific warning about the next quarter. They flagged Q2 as having the lowest year-over-year EPS growth of the entire fiscal year.
Okay, so they're basically managing expectations downwards aggressively for Q2, telling everyone this is the bottom.
Pretty much. They're guiding for the pain point. And it's driven by those higher beef costs hitting the books, combined with their plan to keep pricing below inflation again in Q2, about 100 basis points below they expect.
Sacrificing Q2 margins to, they hope, win market share and set up for a better second half if costs normalize.
That seems to be the exact strategy, a calculated risk.
All right, let's zoom out a bit. What's the bigger picture for investors here, the macro environment?
Well, interestingly, despite inflation worries, casual dining overall is holding up quite well. Management noted traffic is actually up year over year across all income groups.
Really? Why is that?
Their take is that casual dining, especially the big players like Darden, have been more disciplined on pricing compared to, say, QSR or other segments.
Yeah.
So relative value looks better.
People are still going out, but they're looking harder for that value sweet spot.
Seems like it. And Darden feels well positioned there. Plus, they're still growing units.
Right. The new restaurant openings, what's the latest there?
They slightly tightened the outlook, now expecting around 65 openings for the year. They feel good about hitting their long-term goal of 3-4% sales growth just from new units.
And they mentioned those newer, smaller prototypes for Yard House and Cheddar's.
Yeah, more efficient boxes, helping the unit economics work even better.
Okay. So the core narrative seems pretty clear then. Top line is humming along nicely, driven by good execution and smart value plays.
Yuck.
But the immediate future is clouded by this big margin squeeze, particularly from beef and seafood costs in Q2 and Q3.
Double check. The market is laser focused on that margin pressure, and Darden's bet that it's temporary.
So what should people be watching for? What are the key catalysts or signposts?
Number one is obvious, commodity costs,
Yeah.
especially beef and seafood. We need to see if those prices actually start to moderate in the second half like management expects. Q2 earnings will give the first real read, but the market will be watching weekly data before that.
When does the bet pay off, basically?
Exactly. And number two, I think, is that Olive Garden lighter portion test.
Right. Will they roll it out nationally?
If that test continues to show strong traffic gains without totally killing the average check, a national rollout could be a huge deal. It fundamentally changes the brand's accessibility. That decision is a major catalyst to watch.
It's interesting, too, they touched on consumer behavior changes. Less snacking, but maybe some surprising trends.
Yeah, the GLP-1 drug point was fascinating, suggesting some people on those weight loss medications might actually choose casual dining more often when they do eat out,
Why?
seeking value, but also a better experience than maybe fast food. It kind of fits perfectly with offering satisfying but maybe slightly smaller value-oriented meals like that Olive Garden test.
Huh. So even that trend could potentially play into their hands if they get the value equation right.
Potentially. It reinforces that when people spend discretionary dollars on dining now, they want quality and value certainty. Darden's scale helps deliver that.
Okay, makes sense. All right, let's shift gears. It's time for the segment everyone secretly waits for.
Or openly waits for.
This is not financial advice, where we cook up a plausible but outrageous trade idea based on the call.
And this time, it's all about that volatility and management's very specific guidance.
Oh.
Look, the market panicked. It sliced 8–10% off the stock because management told them Q2 would be the low point for earnings growth.
They literally guided for the trough.
Right. Because of their pricing strategy and their deliberate choice to be underhedged on beef, betting costs will fall. So they've basically signposted the moment of maximum pessimism, haven't they?
So the trade idea leverages that timing.
Exactly. It's a time-based volatility and earnings play. The pitch is you sell puts on DRI stock.
Sell puts. Okay, a bullish stance ultimately.
Right. But timed specifically for expiration just before the Q2 earnings release in mid-December. You're betting the stock hits peak panic, peak fear right before that number comes out. You collect premium betting, it doesn't fall further right at the moment of truth.
Okay, selling puts into the expected trough. What's the other side of the trade? Or is that it?
Well, you could pair it. Simultaneously, you could take a longer-term bullish position, maybe buy deferred commodity contracts linked to beef, betting on that normalization after Q2, Q3.
Or just buy the stock or call options.
Or long-dated call options on DRI itself, yeah. The core bet is the same. Management is right about the cost normalization in the second half. Q2 is the floor, and you catch the rebound after everyone else has panicked.
So sell puts for the Q2 bottom, go long calls or commodities for the H2 rebound, betting entirely on management's conviction.
It's definitely high condition.
Understood.
Definitely not financial advice. But it flows directly from their commentary.
A bold play based on taking management at their word about Q2 being the absolute low.
That's the essence of it.
Okay, so let's wrap this deep dive up. Key takeaway.
Darden nailed the execution on sales. Olive Garden, LongHorn, the momentum is real. Guests are responding to the value and the innovation. But the stock's fate, at least for the next couple of quarters, is almost entirely tied to this gamble on beef and seafood costs. Can they navigate this margin squeeze without blinking? Will their bet on normalization pay off?
That's the whole story right now. Execution versus cost pressure.
Pretty much.
All right, final provocative thought for you, the listener, to chew on.
Management confirms that the Olive Garden lighter portions test is driving traffic. It's working to broaden access.
Right.
So, here's the question. If Darden decides to roll that out nationally, fundamentally shifting the value perception of America's biggest casual dining brand. What does that do to everyone else? Will competitors who've been maybe more focused on protecting their own margins through higher prices be forced to follow suit? Could Darden trigger a value reset across the entire casual dining landscape?
If Olive Garden pivots hard to accessibility, does it force everyone else's hand? That is something to watch, a potential strategic ripple effect.
Could be a tectonic shift, really. That national rollout decision feels pivotal.
Indeed. Okay, that's our deep dive on Darden. Thanks for tuning in to Talk Tickers.